Mountain Time. That's 8:30 EST, and shaping up to be a relatively quiet morning in the markets. There are not any what do you call it, announcements, no economic data coming out. So unless there is some surprise news, it's probably going to be chill. Although the Monday morning open can have some volatility just by virtue of it being the Monday morning open. So we are going to keep an eye on the charts today, and that's an hour from now. So in the meantime, maybe we'll just kind of peruse through the charts, take a look at things, and we're going to see if anybody has any questions. So let me take a look and see. We just got a handful of people watching right now. So I'm going to go ahead and grab the link, send it out to Discord, and we'll see if a few more people want to join us. While we listen to our chill hop. Chill hop. Some nice relaxing music. Let's see here. Huh. That's kind of odd. Yeah, there we go. Having some trouble with Discord, but it's back. Let me go ahead and send this out. Okay, link is out. Perfect. All right. Yeah, let me go ahead and give me just one moment, everybody, about 10 seconds here or less. Okay, just straightening a couple things out. Got some family here for the weekend. As you all know, I've got a new baby, so we got people visiting, and that's a lovely thing. That's a good weekend to do it. September can be a rather slow month. All right, let's see here. I'll just start going through the charts. I can tell you the DXY is probably the place to look. So let me get the chart ready for everybody to see up on the screen. I can tell you it's just pushing up. That's for sure. Pushing up strong. So the DXY, for those who do not know, is the dollar index. Okay, so this is the dollar strength as compared to other currencies, right? Not compared to gold, not compared to stocks or anything like that. It's compared to other currencies, right? So a lot of people make a mistake. Say, oh, the dollar's getting stronger. Well, okay, it is, but what is it getting stronger against? And you'll look over time and you'll notice things like gold have just been getting stronger against the dollar over time. But you have these kind of microcosm times where the dollar is getting stronger against a lot of things, and we've been in one of those. For those who follow us, you're already aware that the interest rates have been being pushed up at a historical rate, or an historical rate, depending on how you speak. And that is going to cause dollar strength to go up. That's just the basic mechanism of interest rates, right? Okay, so let me go ahead and jump to a little bit higher of a time frame. We're going to look at a weekly chart, okay? And did some notation here from the last class we did. I'm going to delete that right now because I like to start with a fresh, clean chart. Some really interesting looking chart. You have interest rate hikes started, I think, in about January of 22. I'd have to go look at this, look at the chart for that. In fact, I could probably overlay it. Fed rate, Fed funds. Okay, let's undo that. I forgot to, well, I didn't forget, but it's just better to do it on a more comparative scale. Okay, so we'll do it on the same percent scale. Oh, wow. Okay, something's wrong with this chart. Let's not do that one. Try the one next to it. Let's do, I mean, it's gone basically from 0 to 5. So of course it's going to, this, dollar chart's gonna not look good if you do the same percent scale. Let's do a new price scale. That ought to help. Okay. So, the Fed funds rate was effectively down at 0, right? A 0.5%, and it's gone up to over 5% now. And that's a massive move. That's I don't know, when you go from 0.05% to 5%, that's going up 100 times, really. It's very difficult to kind of measure the rate at which the Fed funds rate has gone up, because it went so low, it was basically 0. It got as low as it could get, and now it's all the way up to 5%. So if it was at 1, if it had gone down to 1, right? So the price scale for the Fed funds rate is on the left. So this is 1% right here, and now it's up above 5%. Why is this drawings? Hold on. There we go. So you see here that orange line is all the way up above 5%. If you look on the left, it's actually at 5.33. So if it went from 1 to 5.33, that's a 5 times, a little bit better than 5 times, but it didn't go from 1 to 5. It went from 0 to 5. Okay. So from a percent increase standpoint, the Fed funds rate has gone up, I don't know, I think like 1,000%, if my head math is correct on that. Because 100% would only be up to, from 0.05 to, 0.05 to 0.1. That's 100%. And it was down there next to 0 from 2020 to 2022, right? If you took the average rate from, say, 2008, so 2008 was sitting at about 0.16, and then it did hike up there for a bit during the Trump administration, mostly. You did have a kind of a move up, but I'd say that the average rate, just eyeballing it, it'd probably be sitting around 1%, right? It was at 0 for like, what is this, from 2009 to 2015. So for 6 years, it was sitting at 0, basically. And then another 2 years, so that's 8 years, it was sitting at 0. And then you had a hike up from 15 to say 20. So for 5 years, it was kind of between 0 and 2. So you had basically maybe an average of 1, right? So you have 0, 1. I mean, the best you could say might be like an average of 0.5, 0.3, something like that. If you go to 0.3 to 5, that's gonna be like 0.3 to 0.6 is 100%, right? So that's nearly 1,000%. That's crazy. That's crazy. I think that's actually nearly 2,000%. So whatever it is, it's a humongous increase. It's different if you go back with the Fed funds rate. If you go look at like the 80s, it went from, I don't know, maybe single digit to 18%. I don't know, maybe 7% up to 18, right? That's like not even a times 3. That's not even a 300%. Well, 18% was really high, but to go from basically 0, right, and to have 10 years of your economy from 2008 to say 2022, so that, what is that, 14 years? For 14 years of your economy to have an average of under 0.5%, from what I'm seeing here, an average of that, you have an entire economy for a decade and a half being built on very little interest rate, okay? And now they're hiking it up to like 5%. Now it's okay. Historically, 5% is actually pretty low. But it's crazy, the percentage. And what that tells us is that we had a lot of malinvestment made possible. Now, I'm not saying it happened. Well, I am saying it happened, but let's just hold possible that whatever investments out there are good. Let's say that some massive industries that are having a hard time right now, let's just say they were fundamentally sound, which many were not, right? Let's just pretend. Even so, when you build an entire industry on basically no interest rate, but like free money, basically free money, you know, and an average of about like I said, 0.5% maybe. I don't know. You know, I could do the math. Just take me a minute. But when you build entire industries based on that, especially when they're politically motivated, and then you hike up the interest rate thousands of percent at the end of it, you're going to see some things fall apart. So, and you know, higher for longer, let's keep talking about. So I just wanted to kind of help everybody understand, you know, what we're looking at. All right. So we're looking at a situation where, you know, it's going to be, there are going to be some machinations. There are going to be probably some swaps on some treasuries to kind of keep some companies alive. There's going to be deals made in the background. But in the meantime, what you'll notice here is that as the interest rate hikes, you'll see hikes in the dollar, right? So if I were to shrink this map up from 2008, right, you see that the interest rate was pretty low. Dollar was hanging out towards the bottom. And then the dollar started heading up in 14. Interest rates started heading up in 15. So dollar started heading up in July of 14. And about a year and 2 months later, interest rates headed up, right? And then interest rates took a dive because COVID, right? That's what we're told. And the dollar did come down, but it never came back down to these pre-pandemic, post-GFC levels. It just stayed up. Dollar just stayed up in comparison to other currencies, right? And then now we have these hikes, and about, what is this? Let's see. June 21 is when we start to really see the increase in earnest of the DXY, dollar compared to other currencies. And February of 22 is when we start to see the hikes. And you'll notice, forgive me. Yeah, let me just fix my screen here. You'll notice though, is that the trajectory of the dollar strength is interesting. Look at this. We've talked about this, but I don't know that if I've done an overlay, right? So the dollar in earnest started going up. You can even take it all the way back to December of 2020, but you know, you don't know if this double bottom is just a reaction. So we'll be conservative and we'll say May of 21. The dollar was headed up from May of 21 to February 22, almost a year. Maybe like, what is that, 10 months, 9 months before interest rate hike happened. But once it did, and actually shortly before it did, you start to see an increase in the trajectory, right? So do you remember our conversation on Friday talking about news and trading news and how people are oil this and, you know, Saudi Arabia that? Well, this is the kind of thing I'm trying to explain to you, is that the Dixie went from 89.70 all the way up to 97.11. So that's going to be about a 10% hike in the Dixie compared to other currencies before the interest rates actually started to get hiked. You know, to be precise, well, no, it's that fits because it did peak right here. So once the public caught wise that the interest rates are going to start going up, that's when the Dixie really started to take off. But there was a massive hike before that, right? So what's happening now? Well, we see it top out, but it could just be simply that everything needed to kind of calm down for a minute in the currency world. Does it mean it's going to continue up or not? Well, I think our clue might come actually by watching the charts. So this is going to be my theory, right? This could be my crux. Okay. So the point here is that the Dixie hiked 10% before interest rates started going up, and it took about 10 months. I'm not saying the timeline is going to match, but I am saying that whenever the rates start to get cut, and I think that might happen sometime next year, I think it might happen, I don't know. I think it might be dependent on when things start to break, right? If things really start to break, stock market starts to slump, things like that, the Dixie may already be going down by that time, right? may already be going down. So you might see whatever price action is going on. Maybe it's kind of headed up here for a while, but I think maybe, I mean, it might actually be right here that it already started going down, right? We might see the predictor already, because this was October of 22, right? We're heading towards October 23. You know, that's like a year later. That's about the same as like 10 months, right? You know, there might be trying to squeeze an extra bit out here. I don't know. I mean, this could be just a reaction. It might not be by design. But I think that the minute you see this support get broken right here, this 98.7, okay? When you see that support, that low level of the Dixie get broken, that's probably a decent clue that the interest rates are going to see a cut at some point. That's what I think. That's how I think it's going to go, just by looking at the charts. So just a nice predictor, but it doesn't mean it's going to happen that way. You know, it's just a way of using the charts to tell you the news ahead of time. Okay, so we'll keep that in mind as we move forward through the show. So we got some Jay Martin. Thank you for all the support there, Jay. Love it. We got a few people watching. Happy Monday morning. Again, as you all know, I tend not to trade before the Monday open, and that's because a lot of things happen over the weekend, and the New York, Forex opens on Sunday, but the New York Stock Exchange doesn't open until 9:30 EST, which is another 45 minutes from now, 43 to be exact. So there's going to be some volatility that's kind of possibly pent up, and it might be hard to see which way that's going to go as the stock exchange opens and currencies are affected. But as of now, the move is certainly bullish on, the trajectory is bullish on the Dixie, right? And as currency traders, we do want to look at that. Okay, so let me go ahead and clean this up. So delete our drawings, delete the Fed funds rate. Okay, so I can tell you the other way to look at it is if the Dixie pierces 114.57, basically 115, and if it stays up there for more than, like, say, a month, then that's really something. You're talking about some serious dollar strength. And I don't know, the amount that we've raised rates so far, I kind of feel like the effect of that has taken place, and now everything is going to equalize, supply, demand, all that kind of stuff. So I don't know, it's just a weird time. But again, that lower bound, 99, basically, price goes below 99 on the Dixie or above 115. Obviously, we're going to be in a form of price discovery, if you will. And that'll tell us a little bit about what's going to happen, I think, with the Fed funds rate. Lisa Gray says, predicting the unpredictable. Yeah, that's kind of it. And you're welcome, Lisa. Yeah, it's, I mean, if you look at key moments in charting, then, the markets are more efficient than anything. The big money knows what's going on before it happens because they're the ones who control it. This is why I like to watch that website. That's the Capital Trades website, because that tells you what the politicians are trading. And they it does take sometimes a week for the data to come out. But, if you see some politician buying some stock, it's like, well, of course they map out policy. They create policy, or I should say they're probably doing the bidding of a large company creating policy, but whatever the situation is, they know the policy ahead of time, right? They have their fingers on the levers of policy. So, there's not much smarter money than politicians, really. I mean, the companies that direct them what to do are going to be a little smarter because they're going to know what they're going to tell the politicians what to do before the politicians know it. So they're going to be the real smart money. But I don't know that we really have access to that information. The Capital Trades, you get to know about it a week or so sometimes after that trade. Maybe a little bit later, depends on the situation. I don't think I have that on here. I think I've somehow shut that website down. So let me go over there. capitaltrades.com. And here's the trades, and I like to sort by published. If there is a way to do that. This box right here, sort by trade date, newest first. So you got, well, I mean, these guys are betting on treasuries going up. Should tell you a lot. You got, or they're just trying to find safe haven. But Dan Bishop, Rudy Yakim, these people are buying in the $250,000 range. Dan Bishop over $500,000, well over like 600 and some odd $1,000 on the 15th of September is buying treasury bills. That's North Carolina. You got let me see here, Pete Sessions over here selling through his spouse, C3.ai. So I don't know if that's like an AI company. They're getting rid of that. What is this? We got Mitch McConnell, whoever directs his stuff is buying Wells Fargo stock. Okay. I don't know. His decisions are questionable. And it's through his spouse. Tommy Tuberville, Alabama, buying Qualcomm. So, these are all 15th September except for, this is the sale date, right? So it's sorted by sale date. It's, traded. So they're published later, but it's sorted by sale date here. So anyway, very interesting stuff. You got a lot going on here. Susan Delbean buying Microsoft on 31st August. It's a little dated now. It was a month ago, but it was also published a week and a half ago, right? What do they know? I don't know. Putting between 500,000 and $1 million into Microsoft and through their spouse's account, right? Isn't this fun? So anyhow, this is Capital Trades. I think it's a pretty useful tool. So that's the smart money. I mean, do what they do, if you ask me. In the meantime, though, as a currency trader, I'm going to look at the Dixie being bullish, and then I'm going to go through, and it's bullish on the high time frame. So that's which way the wind is blowing, right? So you can have times in the lower time frames when it's going to come up against resistance and it's not going to go up. But if you look at the chart right here, since July, it's done nothing but go up. And I know I've talked about this already, but there's not a single candle going in the other direction. And every time it does, like this one candle here with that long wick, this guy right here, that sucker's it tried to go down, got pushed up. So any of these candles with a long wick in the bottom, that's a very bullish symbol right there, bullish sign. Especially because the following candles kept going up. So there's just a lot of upward pressure on the dollar. It is at a resistance, but from what I'm seeing, it's not going to stop. And from a charting standpoint, it doesn't look like it wants to stop. We might be looking into some interesting times in currency right now. So what does that mean from a trading standpoint? Well, we can say look at the euro. I know there's some very smart traders out there who ignore the EUR-USD, right? And they ignore it because there's a lot of liquidity grabs. We're seeing one possibly right now. So we'll look on the 30-minute chart. I can tell you chart-wise, it is bearish, certainly. Every pop-up is being sold, so we look to sell the pop-ups, right? If this was like a Tuesday, then I probably would have tried to sell this move up. Let me do this for you, help you see it better. So if this is like a Tuesday, at 4:30 a.m. this morning, price rallied up and got pushed down, and it just shows you how bearish things are. Every little move up is being crushed. So at this point, though, if you look here, you've got the euro bouncing off a support kind of around here, basically. This area around this line, maybe a little bit lower. And so price is going to want to get below that. And another thing to look at to kind of show that price may dump below that is that you have this continual, every single, like all these highs are getting lower on average, right? So let me put some visual aids here. You got this high, you got this high, that one, that one, that one. So you see how it just, every time it tries to head up, it just keeps getting stuffed. Well, that is a sign that because each of these rallies being knocked down is happening sooner and sooner and sooner, that means that the bulls are losing steam and the bears are strong because it keeps going down to that same area. And the bulls kick in when it gets down to about roughly $1.06. But the bulls can't keep it up. Yep. Bears keep knocking it down sooner. So it may very well, if it doesn't happen now, it'll probably happen later. But what may happen is that, you'll see price kind of head down. Let me look at some old data here. Nothing really to look at. So you might see a kind of a bearish retest like this, maybe, or even just right here, and then head down. And that might be the trade to take. And then I'm going to zoom out to a higher time frame just to look at some older data. And I can show you that it's riding on an older support right now. In fact, it's broken below that older support. So I would look even farther back right here, right? Because there's a support right there, but it's broken below that. It's riding it now, and it's broken below that, right? So the old support, the more recent support is at 30 May of 23. This is a few months ago. But if you look back in March, that right there is probably the next place price is going to travel to. And the way we can trade this, now that we have marked this lower bound, we can go back to the lower time frame. Maybe like we'll say the 3 hour in this case. And we'll see that lower blue line. You'll see it here in a minute. There it is. What's probably going to happen is that you're going to see a price make its way down, but on the way, it's going to rally up, I mean, unless events get severe, that's probably going to how it's going to happen. And from a trajectory standpoint, there's time for this to happen before the end of the month. So, I'm expecting the next week or so, the next 6 days, 5 or 6 days, I'm expecting it to be relatively calm. We probably have FOMC minutes coming up. Let's see. Saturday, September 23rd. Okay, so let's look at the week real quick, and then we'll hop over to the private. The Grill is going to join us any minute. He's on international phone calls, and Thursday is going to be big day for drips, apparently. So he's getting a lot of information right now as a byproduct of his business. So tomorrow, Tuesday, we have consumer confidence at 8 a.m. That's 10 a.m. EST. 10 a.m. EST. So there will be some volatility at 10 a.m. So if I were trading, I would make sure that I was either out of my positions by 8 a.m. 10 a.m. EST, or I would have some real tight stops. And then there will be some volatility at that time through the midday. A little bit, some more information about new home sales, but it's a medium impact event. Something, it may or may not matter, but it's all at the same time. So effectively, it doesn't matter, right? And then on Wednesday, we have a couple of more medium impact events around, say, 8:30 a.m. EST, durable goods, stuff like that. That might add a little bit of volatility. So that might be good because it's pre-market open. So it might just kind of give us a little spice for the day. Thursday, if you're trading the London Open, there's CPI data coming out. That's big. It's gonna be big for Europe, right? Because CPI is the inflation, review, and that's what matters right now in a big way. And then 6:30 a.m. is GDP and unemployment claims. Unemployment is every week. It's important, but it's every week. The GDP quarter over quarter, that's a big one, right? That's looking at the last 3 months and the United States GDP quarter over quarter. So that's going to hit pretty hard at 8:30 a.m. EST, 1 hour before market open. And what's even bigger is going to be Fed Chair Powell speaking. So it might be that GDP doesn't hit quite as hard because the market is going to have money on the sidelines, and see what happens at 2 p.m. when Chowell, my buddy Chowell, Chair Powell, so he's going to talk, and it's hosted by the Fed, by the way. So anytime he talks about anything, the market just kind of hangs out and looks to hear what he says. But I guarantee you, he's probably just going to say, we're waiting for data to come, and, we're higher for longer. And, I doubt he's going to have anything dovish to say. Okay. And then Friday, it's probably be real quiet. All right, because this is it. It's the last Friday of the month. We got PCE price index, maybe a little volatility, maybe a little spice. University of Michigan consumer. I mean, there's a little data coming out early in Friday, but I'd say that Friday's probably going to be junk after about 10 a.m. I probably wouldn't trade at all Friday or very much. A good day to study, good day to backtest. Because look, it's the end of the month. So the end of the quarter and the end of the month. It's the last trading day of the quarter. I can tell you it's a dangerous day historically to trade because people have to basically, they have to rebalance their, what do you call it? They rebalance their funds. So the way this works, and I'll flip over to private after I say this, but the way it works is that all of these funds are generally measured based on monthly and quarterly numbers. So if you are a hedge fund or even an asset manager and you need to show quarterly profit, well, if you're just barely in profit at the end of the quarter, you've met your metric or you're close to it, the last thing you're going to do is take a risk and go trade and ruin that number, right? If you're like way ahead and you're, that's another story. You might play, but most of the time towards the end of the quarter, things get quiet, books get rebalanced, people, they position, and that's how it works. We got the Gorilla on just in time to give us that send off and head over to the private. And Gorilla, you got some drips coming on Thursday, I think you said?
Major, 4 majors. Intel coming to all of you guys that are members of the Algo Factory private lab room this Thursday. Huge news on gold, huge news on Bitcoin, huge news on the FedWire, huge news on Swift.
I don't know. It could be more major than last week's strips.
Oh, dude. It's going to get bigger and bigger because here's the thing, folks. 2024. I predicted going into 2023 it's going to be a hell of a year, and it is. It's been a hell of a year. It's been paradigm altering 2023. 2024 is going to be paradigm shattering. If you think that there's going to be some sort of an election or whatnot, you got something coming to you.
What are you saying there? Wow, I've heard people make such comments.
Yeah, you got to come to you. Look, let me explain something to you guys. This is why it's so vital. I'm really convinced as the days go by that Algo Factory is perhaps the greatest gift we can give somebody. And I'll tell you why. With every global event that's going to happen, the only way you're going to profit from it, 5x, 10x, 20x, 30x, 40x, depending on how hard you studied, depending on how hard you do your back testing, depending on how you work your algos. The only way you're going to do it and profit from the situation that's about to come is right here on algofactory.tech. Right here. Right here. Because if you think 2023 was crazy, I mean, we've seen a lot of stuff in 2023, a lot of stuff. That is nothing compared to what is ahead. Big things are going to be dropping this Thursday. If you need to be a part of it, look, this is information I don't even give on Rogue. Okay, I don't give this information on Rogue. It's only on algofactory.tech. Look, you need to join. You need to learn the intel and then learn and educate yourself through the courses that we have here and the clinic that Cowboy puts on, and then profit from it. So this is massive. The members are in for a treat. Everybody just buckle your seatbelts. And with that being said, Cowboy, let's get into the private room.
All right, let's do it.